Right now, let's start this example. I discussed the content of the scope of IFRS 2. Now we need to do this example and we'll understand what will happen. What it says, MN, a listed company, rewards its senior employees from time to time by granting share option. On 1st January 2021, it grants each senior employee an option of 10,000 shares. Now in that option, they are going to give 10,000 shares at exercise price of market value of a share on 1st January X1 at 7 rupees. The option is to be exercised on or after 20x4. Now the offer is the employees, senior employees will be able to buy shares of 10,000 at the end of 20x4 after 3 years. January, February, March. At the end of 3 years, right? So then look, the diagram is there. For the price of price of 7. Now price is 7. Now the current price also 7. Now what is the target? This is kind of different target that I told you previously. What happens now? Now price is 7. You are allowed to buy shares. How many shares? 10,000 shares at the end of 3 years for 7 rupees. Understand? Three years later, the value of share is rupees 8. Senior employee A decides to exercise the option. Yes or no? Yes, definitely this person will buy shares from the market for 7. Why? Now the market price at the end of 3rd year is 8. Then what is your gain? 1 rupee per share. Now promise is given at the beginning of the year to buy 10,000 shares at the end of 3rd year. That means to buy shares, what you have to do? You have to work for the company for next 3 years. You can't leave the organization. Also, you have to perform well. If market price comes down, what happens? No point of buying shares. If market price increase, what happens? You can buy it for 7, then you can sell it at high price, get a capital gain from the market. It's your target. So that's why now we call it kind of the motivational factor we give to employees to stay with the organization and to work well or perform well for the company. Now if the market price is 8, those people will buy shares and they will get a gain of 1 rupee per share. But if market price is 7, what will happen? Sorry, not 7. Market price is 6. Nobody will buy. Why? You have to pay how much? 7 to buy shares. If you go to market with these shares, what is market value of that day? On that date, it's 7. So it's 6. Therefore, you will have a loss of 1 rupee. So then, what you have to do? You have to work for the company first 3 years to get this kind of gain. Now anyway, one side, let's say if the market price is 8, what is employee's gain? 10,000 into 1 rupee. Because you will buy from the company for 7, go to market and sell it for 8. Then your gain will be how much? 1 rupee per share, it's 10,000. Now we are going to learn how to account for this 10,000. What kind of share-based transaction is it? I told you 2 types of share-based transactions. What are those? Equity settled share-based transaction and cash settled share-based transaction. What is this? This is equity. Why? At the end of the period, employees are allowed to take what? Shares. Therefore, we call it equity settled share-based transaction. Equity settled one. Understand? Now the question. Some people say we should recognize this 10,000 as an expense to employer. Some people argue, no, we don't want to recognize this 10,000 as an expense to employer. Now we are anyway accounting for the employer, not for employee. Understand? What was the first argument I told you? I told you that 10,000 should be recognized. $10,000. This is for 3 years period. I had this picture. On this point of time, we will able to get 10,000 as kind of income to employee, expense to employer. What was our theory? Employee provided service over these 3 years, therefore that 10,000 should be recognized as an expense over service period to comply with matching concept. Understand? So therefore some people say, yes, we need to recognize this as an expense to employer. Understand? It is good. Therefore, look, there are some arguments to recognize this as an expense, share-based transaction as an expense. We call them arguments for recognition. Some people say, yes, we need to recognize this. Why? One reason already I told you. What is it? To comply with, somewhere it will be, matching concept. That's what I was talking about. Look. To comply with matching concept, we need to recognize this 10,000 as an expense. The other argument is, look, anyway now, let's assume now there are two set of employees. For one side I say, okay, now you can have 100,000 salary per month. That's the only package you have. For the other party I say, you have 100,000 salary plus kind of share-based increment or the kind of incentive at the end of third year. Who will produce more? You or this party? Definitely these people will produce more. Why? They have kind of indirect incentive which is to be received at the end of the third year. You don't have. You will just work for the salary. That's it. You don't have any other target. In your case, you have kind of incentive which is to be earned at the end of the third year if and only if you work well for the company. So therefore anyway you work well. Why? You have kind of target to achieve at the end of the third year. So therefore, now what happens? Both are part of remuneration. Remuneration? So I pay 100,000 for both of you. In addition to that, I have kind of promise given to pay something extra at the end of third year. It's also part of my remuneration package that I offered to you. So therefore remuneration should be recognized as an what? Expense. No doubt at all. Which is part of remuneration package, it should be recognized as an expense to measure the real performance of the company. Real performance of the company. Therefore it says, look, to measure real expense in the business, in income statement, I need to recognize this promise cost. There is hidden cost in the promise. Hidden cost. It is not appeared. Hidden cost also should be recognized as part of expense. Therefore some people say, yes, we need to recognize this as an expense. We are talking about financial reporting issues. So look, now it's kind of issue. There are two sides. I will show you the other side later, negative side. Still I am talking about positive side. We say, yes, recognize this. There are big arguments. No, we should not recognize this. Right? I'll show you. Even it is from IFRS. Right? Then there is another one. Look, to assess the real managerial capacity, we need to recognize this. Why? Let's say a good example. At the beginning of the first year, in my example, this is 3-year example. At the beginning of the year, first year, I come and give the offer. Right? Then I say, okay, now you can have this kind of package. At the end of the third year, you can have a commission or shares. Promise is given by me. Then in the first year, what my employees do? They will work more for the company. As a result of my managerial performance also increase. Then card the credit again. Company performance, it's to me. What I have given you? A promise, only words. Maybe sometime a document, promise. Then I left the company at the end of the first year, showing my performance. Then second person will come. So then he has run another 2 years. At the end of the third year, what happens? Employees will say, now the previous manager gave a promise like this. Now the company should pay us kind of commission because we have increased the share price. Who has to take that burden? That is by the new manager. Understand? So therefore, what is your conclusion? To assess the real managers or managerial capacity, we need to recognize this as an expense. Otherwise, people will go. The new person or the fourth year manager will have to take all these burdens in his period. Why? Money will be paid when? At the end of the third year. First 2 years or first year or maybe first 3 years, other people will get the work done from employees and they will left, but the new one has to take the full burden. So it is not fair. So therefore, to assess real managerial capacity or managerial stewardship we need to recognize this thing as an expense. You see, now I told you 3 points. To see why we need to recognize this. Then another point, this is not that much powerful, but mostly we say, if everybody recognize this thing, this expense, the employer cost or employee benefit, into books of accounts, we can keep comparability of financial statements. If one company recognizes and if other doesn't, can you keep comparability? No. So therefore what standard says, everybody should recognize this thing, then it won't be a problem. If everybody in the market do this thing, if everybody in the market recognize this thing, won't be a problem. Why? Everybody recognize it like that. Therefore there is no harm for the comparability. Let's say now these companies are recognizing, these companies are not recognizing, what happens? Then can't compare. So therefore standard says everybody should apply this. Then no problem. But there are some arguments against this. Some people argue, no, this is kind of complex transaction. We should not recognize in the books of accounts because we don't know what will be the share price at the end of the third year or fourth year or whatever number of years. We don't know what will be the real cost to employer at the end of the promise. When we are delivering the promise, we don't know the real cost. Therefore, we should not recognize. Therefore, people say, look, this is kind of complicated transaction. Lot of management estimates will involve in this kind of transactions. Therefore, you are going to mislead financial statements or information. Therefore, people argue this kind of complex transaction should not be recognized in the books of accounts. Just do a disclosure, qualitative disclosure, it is enough. That's one thing, right? So other one is, look, this is the main argument, these two. Sorry. The second and the third are the main arguments. In a previous case, I told if I give shares at the end of the period, to employer, do I have any cost? I don't pay anything. What I give? I give only shares. You take shares from the company, go to market, sell it and get a gain. Is there any cost to employer? No cost to employer. To recognize expense, if you can remember expense definition from the accounting framework, what's it? What is expense definition? To recognize something as an expense, there should be economic outflow which leads to increase asset, decrease liability. So I made a mistake. Decrease asset, increase liability or decrease equity other than distributions made to equity participant other than. That's why we didn't recognize dividends and drawings as an expense. Now there are two problems here. Is there any economic outflow from the company? Is there any economic outflow? No economic outflow. I just give only shares. Understand? So then the other hand, it is paid to whom? Employees. Later they will become shareholders. Now it's not clear whether it is equity participants or somebody else. But they are going to become equity participants after getting this thing. Anyway, main argument, there is no economic outflow. There is no economic outflow. Therefore, people argue we are not in a position to recognize this as an expense. But in the case of cash settled share based transaction, it's true. Why? I pay cash at the end of the period. I pay commission in the form of cash. Therefore, there is economic outflow. Look, this is very interesting. Usually what happens if you work more or if you perform well in the company, what happens to EPS? Earning per share? It should be increase or decrease? Increase. Usually you know if company is performing well, earning per share, how to take it? How to calculate earning per share? Hopefully you have learned in financial something. Ratio. Now this time for the first time I do some lectures for what is called, what is the subject? I remember. What is subject? Financial statement analysis, no? Financial statement analysis, yes, right? I have I think 4 lectures or 5 lectures. Oh. Right. Lot of disturbance today. What I told you fine? EPS. Yes, right? So how to calculate EPS? Profit after tax minus preference dividend divided by number of shares. Hope you have learned in financial statement analysis. Understand started no? Learn this thing? No, not yet. Not yet, right. So then what happens as a result of this adjustment? If I recognize expense, what happens to my, if I recognize artificially something as an expense, what happens to my profit? It goes down. The numerator goes down means what happens to the answer? So if numerator goes down, answer will go down. On the other hand, if I give shares to employees at the end of the period, my number of shares will be increased. When denominator goes up, when number of shares goes up, what happens? To answer again, answer comes down. Look now, as a result of now, good thing, I gave a promise to employees, they work well, they perform well, as a result of that share price went up. But what happens to my EPS? It came down with double impact. Why? Since EPS goes down, since profit goes down, EPS comes down. Since my number of shares goes up, again EPS goes down. There is two impacts. EPS hit twice as a result of this. It means usually what should happen? When people are performing well in my organization, if employees are contributing more to the organization, my EPS should be increased. As a result of this adjustment, what happens? It comes down twice. Double impact. Double negative impact to EPS. Is it a good thing? No, it's not a good thing. So therefore people say recognizing this is not acceptable. Understood? And also now even US there is argument, they also don't recognize due to these disadvantages. Actually people will not recognize. When it comes to Asian countries, these are not the big impact. The biggest problem is not that. In our market, what happens now? This is paid based on market price per share. In our market, what happens? In our share market is not that kind of developed market compared to other markets in USA and UK, Australia, etc., Canada, etc. So what happens in our market? Even new election comes, market prices are highly volatile. Not because of the performance of the company. Even let's say one CEO comes from one to another company. One CEO is resigning from one company and join for another company. What happens to share price? Sometimes one goes up, one goes down. Understand? Even let's say now budget speech came. Some share prices went up, some came down. It means in developing markets or underdeveloped markets, the profit will not have in kind of positive correlation to market price per share. Therefore, if you pay something based on market price per share, it is not the real picture of the performance of employees. Even employees are performing well, since our market is manipulated by some key people in the market. So share price will not represent or will not be a good proxy for company performance. It is not there in slides, right? Actually in our market, in Sri Lanka, especially Asian countries, share market price is not a good proxy for performance of the company. So therefore, the application of this is questionable in our country. Still people do it, right? Therefore, there is no rationale behind this. Sometimes even employees are not performing at all due to some political involvements. Share price go up. It happens. Even companies are performing well. Sometimes it happens for a company, I don't want to disclose the name since it is recorded. With the new government came, well company prices came down because previously they had big contacts with the previous government. People realized no, not because of the performance, sure their performance will go because new government came into power. They are in the opposite side. Because that people had good contacts with the previous government people, definitely what happens? That they will be attacked. Sure. So therefore, actually that thing happened. Even people thought in the market. Same now if you look the current context, I don't want to disclose the name. It's kind of the trading business is vehicles, right? So you can imagine the company. So their market share came down little. The income also little came down because of the political decisions, right? So then what happens? Is it the performance? Not the real performance because of the political involvements, right? Anyway, still employees are working well. That means employees are good, they are performing well. Due to some political reasons, market prices are coming down. So therefore, it's a big question inside this. Now hope you can understand. It was last time question actually. I asked what are the arguments against and arguments for recognition of EPS in books of accounts. Sorry, recognition of share-based transactions in books of accounts. Right? Right. Now balance part very easy. Anyway, now according to IFRS to what we are trying to do, we recognize or we do not recognize now. Recognize කරනවද නැද්ද? ඈ බෑ වගේද මේක? හා? මොකද දෙන්නේ? There are 50-50. There are good arguments for recognizing. Also there are some good arguments not to recognize these. Especially when it comes to Asian market. What's the purpose of recognizing this? There are some questions in our mind. That's why we discuss this thing, and that's the part actually I need to discuss on the financial reporting issues. Usually I spend 1 hour now. Right? Yes, exactly 1 hour. So that's the part I need to discuss, but since we do IFRS 2, we do the accounting part also, right? So anyway, now we can understand, anyway, we have some questions if you recognize like this. In employee benefits also we do something like that. Then what recognize කරනවද නැද්ද? Do recognize? Yes, we'll do then, right? Because IFRS 2 says, standard says, yes, we need to account for this. Their argument is for recognizing, that's why they have issued this now. They have given a set of guidance to recognize this under IFRS number 2, right? So therefore we'll see how to recognize. Basically I told you now, these are previous arguments not inside IFRS 2. Now only I am coming into IFRS 2. IFRS 2 doesn't discuss about these negatives, right? So they say you have to do this, right? But addition to that, I just discuss about some positives and negatives of this. So that's what we should do actually. In this level, we should understand this. I'm not sure how to understand this thing because sometimes you can't remember very basic concepts even. So then you have to remember those, but apply those concepts. What was the main concept inside this IFRS 2? It is matching concept. And accrual also there, right? I'll come to that point later. Right, basically actually, you know, according to IFRS 2, there is no big argument whether 2 classifications or 3 classifications. You look this, there are 3 blocks here. But basically, some people say it's 2 and some people say no, it's 3. But you can understand the mix. First thing I told you, equity settled share based transaction. It means at the end of the agreed period, or we call it now technical term, vesting period. That's a term given by the standard. What is vesting period? In my example, I told you, at the end of the 4th year, if you increase share price by this condition, this percentage, you will get something. Maybe shares or maybe cash. If you get shares at the end of the period, we call it equity settled share based transactions. If you get cash at the end of the period, we call it cash settled share based transaction. There is another option. Employees can decide whether you need to have equity or shares at the end of the period. What is that thing? Mix of that too. So that is last one, third one. Look, transaction which the entity receives goods or services and either entity supplier has choice. That means the people, employees have a choice to decide whether they go for equity or cash, or sometimes maybe goods and services. It seems like cash. So let's say now at the end of the period, let's say if I am running a retail network, like what is called Food City, Cargill, so Arpic or something, retail network, what I can offer? I can tell you, okay, now if you increase my share price in the market, you have to buy 5,000 worth of goods from my retail outlets in New Year period. It's possible now. Kind of encouragement point to everybody. Why? Then everybody will work hard over first 3 months of the year to get something at the end of the year and New Year festival. You can go and you can do shopping for 10,000 worth of goods. If you increase my share price, it means to increase share price, what you have to do? You have to work hard for the company. Right? So then it's good point. Then I have kind of, even 10,000 is not my cost. Why? You will come back and buy goods and services from me. Inside it I have kind of profit margin. Because you are going to come back to me now again. It means you have to buy goods and services from my, there is a profit inside it. Even though I say 10,000 worth of thing you can take, your cost is not 10,000. You have some, I have some profit margin inside it. Let's say 20% profit means, what is my real cost? It is only 800. Why? 800,000, sorry, 8,000, right? 8,000 because of my margin. Same thing we will discuss in IFRIC number 15 or 17, I can't remember the number. We call it non-cash distributions to owners. If any company pay dividends in the form of non-cash modes, this kind of thing, dividend also can be paid like now. I propose dividend to you, let's say assume, now these are my shareholders. I propose dividends to you, but don't pay cash. What I tell you, you come and buy goods and services from my outlets. Possible. Chiran and all, they did something like that. You go and buy goods and services from KFC. Possible. So then we will discuss it later anyway under IFRICs. Here we are talking about equity settle, cash settle. Oh, the people will have a choice. It means mix of that two. So that's why there is no universally accepted method to classify it like whether 3 or 2. Some people say now these are the 2, but mix of that is another one. We call it 3 then, right? I'll come to double entries later. There are certain terms you need to understand. Those are not important to memorize. In our example, I told you already one term, vesting period. That is number of years the offer is given. Vesting condition. Those are important to, you have to remember. What is vesting condition? In my example, I told you, you have to stay with me for next 3 years or increase my share price by 20%. Then there are 2 vesting conditions. One, you have to stay with me for next 3 years, otherwise you are not eligible to take it. Second, you have to work increase the share price by certain percentage. If both are satisfied, only you can take something from the company. We call them vesting conditions. Right? Just having those things. Some are market based and some are non-market based. What is market based? In my example, length of the service, it is not market based transaction condition. But the share, it is market based condition. Length of the service of employee means you have to stay, you have to work with me for 3 years. It's not kind of market based now. It's kind of qualitative fact. Right, look now. We are going to discuss the first part. What's it? Equity settled share based transactions. We are going to learn how to account for this. What are the questions in our mind now? We are going to account like this. Major problem will come. What amount will be, or how many shares, or how much worth of shares will be given to employees at the end of the period? We don't know. So we are going to make kind of estimate based on fair value now. Understand? Anyway, a few points to be noted. Fair value anyway, it doesn't matter. When you take equity settled share based transaction, at the end of each year, the story is like this. At the end of each year, we have to measure the value based on what? Fair value of the option. I'll tell you how to take it later. The fair value is not measurable at the end of each year. The fair value of the equity instrument is not measurable at the end of each year. Sorry, made a mistake. Fair value of goods and services cannot be measured at the end of each year. I need to take the fair value of shares at the grant date. Another technical term. What is grant date? Grant date in my example, that is the promising date at the beginning of the period. When do you give the promise to these employees? That is we call granting date or grant date. Understand? We need to account based on fair value on grant date relating to what? Equity settled share based transaction. Just to understand, you remember only that 2 points. We need to take fair value on which date? Grant date. Remember the point and go ahead. Just see this example now. What it says. GH granted 100 share options to all employees who had been, look now, this is different condition, who had been within the entity for last, how many months? Last 12 months. No condition relating to market base. This is simplified one. Very simple example, how it comes. Let's assume all these are employees. Now what is my proposal? I propose everybody who has completed 1 year in my organization are eligible to take how many shares? 100 shares. 100 shares at which value? Option had value of 2.50 at the grant date. Fair value of that option is 2. Let's assume that's market price per share. Very simple. So then what will happen? This offer is made based on prior service. No condition to be satisfied in the future. No condition. If you have completed one organization, you are eligible to take this. What is my expense now? When do you recognize expense? Now look, this is my year. If you have completed last 1 year, in this year I am going to propose a package. What is the package? You are eligible to take 100 shares if you have completed 1 year, just to motivate people. How much is my expense now? 2.50 into 100. How many people I have? 200 employees. Then what is the value? 200 into 100 into 2.5. What is it? It's 50,000. Right? 100 into 2.5 into 200. It's 50,000. Look, when do you recognize as an expense? You recognize it as an expense at the end of that particular year. If it is completed last 12 months, when you make the proposal, you recognize it as an expense. How? Staff cost debit. Where to credit? Credit to other reserves. When employees take shares, where to put it? Other reserve should be transferred to share capital. Understand? So that's how we do equity settled share based transaction if it is provided based on previous conditions. Those are not future conditions. Understand? Example number 3. Look what it says. This is not based on previous conditions. This is based on future conditions. What are the future conditions? Now what it says? B grants share options to its 1,000 employees in the year to 31st December 20x6. Each employee is entitled to 300 options, and if they stay with B, means the company, for next how many years? 3 years. It's like example I gave you. It means this employee should stay with the company for next 3 years to entitle for this benefit. Understand? What is fair value of the option at the grant date? Again, it is 2.50 given. Now assume we are at the end of year 1. What we need to do? We need to take the value at the end of year 1. How it happens? Look, we are somewhere here now. At the end of the year 1. At the end of the year 1, what is the estimate? What it says? Look, at the end of 20x6 means the year 1, maybe 16 or whatever the year. 60 staff left. Now look, even we have how many employees? 1,000 employees. 60 people resign from the organization. Then do you pay them? No, you don't want to pay anything to them because they left the company. Right? So then 60 people left, and they have estimated that another 80 people will leave over next 2 years. What is total time period? It is 3 years. Now assume that we are at the end of year 1. When did you give the promise? It is at the beginning of year 3. Sorry, made a mistake. At the beginning of year 1. Somewhere here. You gave the promise somewhere here. Anyway, we need to make the adjustment at the end of year 1. In that case, they have estimated that 60 people already left during this year and another 80 will leave over next 2 years. Then what is total number of employees we have estimated for the period? Finally, it is only how many people? 1000 minus 60 left already, another 80 will leave, 1000 minus 140. What is it? 800. According to year 1, according to estimate made at the end of the year 1, look this one. According to the estimate made at the end of year 1, I expect only 860 employees will claim this one from the organization. Then what is total value that I am expecting to pay at the end of year 3, but the estimate is made at the end of year 1. How much is it? 860 into 2.50 into how many employees? Sorry, 300, not employees, 300 options per employee. 300 into 860 into, look, 2.5 into 860 into 300 means 645. It is total estimate of expense at the end of year 3, but for how many years this thing? For 3 years, therefore we have to divide it by 3. Then first year expense will be how much? It's 215. Double entry, look. Staff cost debit 215, other reserves account credit 215. We recognize it as part of equity. Understand? Right. Now we will move to the year 2. Now we are at the end of year 2, somewhere here. We are at the end of year 2. First year already we have recognized 215 as an expense for the year 1, P&L or the income statement, debit, other reserves account credit. It's done. We move to year 2, what it has happened now? At the end of the year 2, what is the estimate? If you go back to question and see what it says. At the end of year 2 means X7, actually 50 people left. In year 6 or the first year, how many people left? 60. Now actually left in the year 2, 50, actually left in the year 1, 60, altogether 110 left at the end of year 2. And also they have estimated that another 40 people will leave in year 3. Then what is my total expectation, employee wise? We have total 1000, already left 60 and another 50 at the end of year 2 and another 40 at the end of year 3. Altogether it will be 150. Then 1000 minus 150 means I have only how many employees at the end of year 3 according to year 2 estimates. Now we make all these estimates somewhere here at the end of year 2, right? What is our expectation? It is 1000 minus 60 minus 50 minus 40, 850, 250 into 850 into 300, it is 637,500 for how many years again? For 3 years. But already we have spent how many years? We are at the end of second year. Therefore, we have to take only two-thirds out of total because we have spent 2 years now. Understand? So then 637.5 divided by 3 into 2 means it is 425,000. But remember, 425 at the end of second year. In the first year already we have recognized how much? 215,000. Therefore, balance should be recognized as an expense for the second year. Got it? How much is it? 210,000. 210,000 only. Look, account is there now. Other reserve, double entry again. Staff cost debit or the profit and loss account debit for the year 2 and credit to other reserve account 210. As a result of that, you look my other reserves account, it is there in my working here. So then in other reserves, in the year 1 P&L we have 215. From the year 2 profit and loss account we have another 210. At the end of the year 2 we have balance of 425. We have one more year to see the real outcome. Now what we have to go for the third year. According to the estimate, question says in year 3 actual left is 20. Now we have completed 3 years. Now we are somewhere here at the end of year 3. Understand? We had total employees in year 1 60 people left, in year 2 50 people left, in year 3 actually how many people left? 20 people left. Altogether now we have only 870 eligible employees. 870 eligible employees. Understand? So therefore 870 into 2.5 into 300 shares means 652,500. It should be now no need to divide it by 12. Sorry, 3. Why? Now we are at the end of third year. So therefore total is, if so you have to divide it by 3 and multiply it by 3. No point. Right? So then total value at the end of the year 3 based on year 3 estimates 652,500, but already we have recognized how much? 425,000 over first 2 years. Over first 2 years, then balance 227,500 should be recognized as an expense to profit and loss account. Got it? Double entry, staff cost debit 227.5 and other reserves credit 227.5. Now finally, you look your reserves account. Now look your reserves account. Over 3 years we have accumulated 652.5 or 652,500 at the end of year 3. Look. Then what happens? At the end of the year 3 as we estimated, what will happen? Already actual people left, no, 60, 50 and 20. They will not claim. These people will get this money. Oh, not money. What is it? Equity. Shares. Then where to put it? Company has given how many shares? 300, no? 300 shares for each of these 850 employees. There is no cost, but we have recorded kind of nominal cost into my books of accounts. It is how much? 652,500. I should charge or transfer it to where? Capital account once shares are given to whom? Employees. Here debit and my capital account credit, then reserve account will be closed. Look the way that we smoothly recognize total 657,500 based on fair value of my option at grant date. Understood? Remember, in your slides you don't have any of these workings, right? Right, therefore you need to have any workings you need, but in slides I think it's there. When it comes to PDF form, it's not there. When you convert into PDF, these workings are not saved. But anyway, in slides you have workings. When you read this, watch these videos, it's there. Typing answers are there anyway. In these things are there, these things are there, the writing things are not there. Right, people who work in the lab, they can save everything, but here it's quite difficult. We can't save these workings. Really, when I do this thing in the previous years in the lab, then I save all these workings. I wrote on the board. Now it's work is very easy. Workings are there, no need to write. In this digital board, it's quite difficult to write. In the small one there, the lab lectern, it's easy to write. We have digital pen there, no? So with that we can write all these workings like that. Right, anyway. That's all about this equity settled share based transactions. Right? So hope now can understand what is equity settled. Year by year we recognize part by part into income statement as an expense. At the end of the period we recognize it as part of share capital or equity. Right? So then we'll have small break for 5 minutes because I need to go down there. So then after this you can have cash settled share based transactions. One question enough, no? From one area. Just refer others later. Yeah, just see this question. Example number 5. Then 1 million options granted for 10 directors. Then share options should be executed shortly after the end of the third year. The vesting period will be 3 years. At the end of the third year, how to exercise it? Director should pay 2 rupees per share and they have to buy it. Look, it's kind of condition given. Then if you can increase the value of shares, your margin will be increased. Right? So if the market price is increased to certain level, even though you pay 2 rupees, doesn't matter. You can have capital gain. The market price per share is, let's assume 5 rupees at the end of the third year. Then you pay 2 rupees and buy shares and sell it at 5 rupees and get a capital gain of 3 rupees per share. But anyway, you will have capital gain tax from April, no, next year. That's how good governance, right? Another tax, right? So those are tax now, thereafter. Big taxes. So you just study, a lot of taxes are imposed now. Even ESC, economic service charge, I think it's now. Increase, no? Decrease the ceiling, as I remember. Right, now, anyway, now we are coming to this. How to recognize? Look now, first question. Show the option scheme will affect for each year over three years. At the end of the first year, how to recognize it? Look, they have expected that 8 million rights will be executed. 8 million rights. And the fair value at the beginning of the year 1. Fair value of the option is how much? 30 cents. When do you do first adjustment? At the beginning of the year or at the end of first year? At the end of first year. When you prepare financial statements at the end of the first year, it has been estimated that expected rights to be executed by these directors is only 7 million. How many rights you gave? 10 into 1 million, it's 10 million. Out of 10 million, some people will leave the organization and some people will not buy shares by spending 2 rupees. They, based on their estimate, It was how much? Only 7 million. At the end of the year 1, at the end of the year 1, what is your value? It is 700,000. How to take it? 7 million into 30 cents into 1/3. Why? This total is for 3 years. Then you have to take only 1/3 because we have completed only 1 year out of these 3 years. Got it? So then 700,000 should be recognized as expense for the year. Profit and loss account debit, I have taken this one here. Profit and loss account debit, and here credit. The other reserve account credit 700,000. Move to second year. At the end of the second year, now we assume somewhere here, yeah. The expected directors options are 8 million. 8 million into what value we have taken? Look. Still 30 cents. Why? If you are not in a position to take the fair value of goods and services given, what you have to take? Take fair value of the grant date. Understand? So you don't know the fair value of the options that you give at the end of the third year, that is goods or service that we provide. Therefore we take the grant date value, because this is equity settled share based transaction. Equity settled. So then grant date one again 30 cents, 8 million into 30 cents, but we have to divide it by 3 and multiply it by 2. Why? We have spent now 2 years. Then the total value will be 1.6 million, but still already we have recognized 700,000. 1.6 million minus 700,000, then what is second year expense? That is 900,000. Then profit and loss account debit for the second year and credit to your other reserves account 900,000. Then finally accumulated balance at the end of the year 2 is 1,600. Understood? Move to third year. Based on the facts in the question, at the end of the third year, total rights to be executed is 9 million. 9 million into 30 cents. No need to divide by 3 and multiply it by 3. You can take as it is. Then value will be 2.7 million. Out of that, already we have recognized 1.6 million. Balance 1.1 million should be recognized as expense for the third year. Expense for the third year. Double entry. Profit and loss account debit 1.1 million in the third year. Other reserves credit 1.1 million in the third year. At the end of the third year, your other reserves balance will show you how much? 2.7 million. Then what happens? As you expect, all directors will buy shares. How many options? 9 million options by spending how much? 2 rupees per share. Assume now these are the things. First part of the question. In the second part, what it says in the question? What it says? Second part, part 1. At the end of the year 3, fair value of share was 5 rupees. Market price per share, let's assume it's 5 rupees. Then as if I are a director, do you like to buy shares from the company? Yes, why? You spend only 2 rupees, but you can have a gain of 3 rupees per share, right? So then how to account for this transaction at the end of the third year? What is your value in your reserves account now? Accumulated value, it is 2.7 million or 2,700. How to account for this? How many shares you are going to give to directors? 9 million shares. 9 million into 2 means 9 million into 2 means 18 million. 18 million, where to credit? 18 million we debit to cash. Why? We collect cash, company will collect cash, 9 million into 2, 18 million. 18 million debit to cash. In your other reserves account, you have balance of how much? 2.7 million or 2,700. Then 2,700 debit, other reserve account, cash debit 18 million, credit to share capital account. This calculation is wrong here. This is wrong. Right? You have to credit to share capital or stated capital how much? 20,700. Look the way. Why? Already you have accounted for fair value of the option as 30 cents. But finally market price of a share is 5, but you sold it for 2. Then your cost is 18 million. You collect cash and everything should be recognized as part of share capital. That's part 2 answer. Then part 3 in the question, what it says? If the fair value is 1.5, 1 rupees and 50 cents. If you are a director, what is your decision? How much you need to pay at the end of 3 years to buy? Those are independent scenarios. Huh? What is the director කෙනෙක් නම්? ගන්නවද නැද්ද? No, why? How much you need to pay to buy shares? 2 rupees. But what is market price now? 1.50. Then you will have loss of 50 cents per share if you buy shares from the company. Therefore, sure, if you are a smart director, you will not exercise this option. Right? That's all about it. That is enough for equity settled share based transaction. We look the last. I thought to do this actually within 1.5 hours. I did a little slow. I wanted to do 2, right? Employee benefits and this. Usually people say every time, so I am little fast. It doesn't matter, even though it is little fast. Why? You have video. You can watch it many times if you need. The question is, I have examined last time. There are some people they have not watched videos at all, but they came for the exam without watching videos. Right? But for this time, it will be really difficult. Yeah, I think we have learned a lot of. We are going to learn a lot of new things this semester. Under this subject, I don't know other subjects. I'm sure you may not learn this thing before, cash share-based transactions, right? For the first time you learn. At least if you can catch 60% when you learn for the first time, that's more than enough. The balance you can complete when you read for the second time. My point is now at least if you come for classes, you have to catch everything within the lecture. Otherwise, no point of coming for the classes. If you study again later, that means you are wasting your time. If you come for the class, you have to catch everything within the class. It means you are doing studies. Then you can save time. You don't want to do any homework thereafter. Other people, what they do? They will work in this time. They will do it or they will study this thing later. If you don't take anything, if you come to the class, it means you are spending double time to get this compared to others. So therefore, if you come for class, you have to take everything within the class time. Otherwise, no point for coming for the class. Right now, second part of this. Up to this level, any question, any clarification? This is easy. Only one entry I need to change. Prashna Mood. Very good. Last or the second row. Any doubt or clarification? Huh? Is it easy? Not easy. This is easy. Yes. What's your name? I can't remember. Thayaraj. Yes. You are online every time. No? Yes. Okay. Huh? Now only one standard, so therefore you can catch it easy. The corner, huh? 50% got, but I thought that you will take at least 75%. Right? Anyway, only few points I told you. The core concept behind share-based transaction. Why do we need to recognize this? Why we should not recognize this? Then the way of recognizing these two types of the share based transactions, equity settled and cash settled. Those are the 6 points I told you. Right, now coming to this last one. It's about cash settled share based transactions. Cash settled means, obviously you can understand now, already I told you the example. At the end of the period, the company will pay cash, or maybe company will give goods and services, not shares, to its employees. So then how to account for this thing? Only one double entry you need to change. In the previous story, you can remember, we debited to profit and loss account as an expense we recognize. On the other side, we recognize it as part of reserve until the vesting period is completed. Understand? So at the end of each year, during the vesting period, we recognize it as part of equity. It is other reserves. It will be taken into statement of owner's equity. In this case, what we do? In each year, we recognize expense to profit and loss account. On the other side, we do not credit to other reserve account, we credit it to a liability account. That's the only difference. Then you can understand, same thing, same pattern, everything is same. At the end of each year, you credit the same amount like we calculated previously, calculation also same, credit to liability account. At the end of the vesting period, what you have to do? In the previous equity settled one, what we did? At the end of the vesting period, we transferred everything to where? Share capital. Here, we don't want to transfer anything to share capital, we need to pay it by cash. So then cash will be credited, liability account will be debited, it will be closed. Understand? So that's the only difference now. That's all about equity cash settled share based transactions. Now, if I complete this thing by within next 10 minutes, the question, I don't have time to start a new one. Oh, we have enough time even, right? 30 minutes we have enough. So then that's the question we have. Usually I wanted to complete this within 1.5 hours. Usually for undergraduates also I do this thing within 1.5 hours. Right, let's see example. Example number 6. We'll do at least one example. It will take time. Hundred eligible staff are entitled to receive payments equivalent to 60% of the increase in value of 1,000 entity shares. Look, 100 eligible staff are there. They will get only 60% of the increased value of shares. Increased value of shares. For how many shares? They are restricted only for 1,000. They don't give shares. But what they say? For 1,000 shares, increment into 60% will be given by cash. Right? During year to 31st December 20X, the share price increased from 0.25 to 0.34 cents, 25 cents to, it's not 0.25, right? 25 cents to 34 cents. Payment made on 31st January 20X9. What is your commission? If you are the employee, how much you will get? It's there, calculation is there. Increment is how much? You have increased the share price from 0.25 to 0.34 means 0.09. 0.09 into 60% into 1,000 shares into 100 staff members. How much is it? Lightning outside. You see, it's blinking here. How much is it? 1,000? 5,400, is it? Exactly. I said 5,400 or 54,000. Something wrong in my calculation. $0.09, no? not 90 cents. It's 9 cents, no? My calculation is wrong, I think. It's 5,400, it doesn't matter, right? 5,400, then double entry will be, what's double entry? Staff cost debit or profit and loss account debit 5,400 and credit how much? 5,400 to liability account. Liability account should be credited by 5,400. That's double entry, right? It's easy work, no? Only for 1 year. Look this up. Going for 2 years. G grants 100 share appreciation rights. Who is SAR? SAR is not there today. Not registered, no? Is Bursa, no? She is Bursa, no? Bursa is not there. Is it? So share appreciation rights, not a senior assistant registrar. SAR means here, right? So anyway, share appreciation rights to its 500 employees during 20x7 on the condition that the employees stay with the entity for next 2 years. Then what is the vesting condition? Employee should stay with this employer. Employee should stay with this employer for next how many years? 2 years. During 20x7, 15 staff leave and another 20 expected to leave in 2008. During 2008, 25 people left actually. Now assume we are at the end of first year. Now what is total number of staff we have? We have total here 500. Out of 500 we have to subtract 15 at the end of year 1 and another 20 for the expected value at the end of year 1. We don't know the actual amount at the end of year 2, therefore we need to take the estimate there. Understand? Now 15 and 20, 35 we have to subtract. Look, 500 employees total we have. 15 employees already left in the year 1 and they have estimated that another 20 will leave at the end of year 2, estimated. Then altogether 35 left, therefore 500 minus 35 means now eligible employees 465. Value per share is how much? Is there in the question? Look this. Fair value of share appreciation right at the end of year 1 is how much? 10 rupees. 10 into 465 into how many share rights? Yeah, 100 share appreciation rights. Total value will be 465,000. But for how many years? We estimate it at the end of the year 1. For how many years? For 2 years. Therefore, divided by 2 into 1. Because already we have spent only 1 year. Understand? So same way like we did in the previous 2 examples. Then value will be 232,500. Double entry should be staff cost debit 232,500 and now not reserve account, we credit it to liability account. At the end of the year 1, you have to recognize liability as 232,500. Got it? Move to next year, second year. Look, in my liability account now we have 232,500 in my accounts. At the end of the year 2, altogether we have 500 employees. In the year 1, actually 15 people left. Estimated in the year 1 that 20 people will leave in year 2, but at the end of year 2 we have realized that 25 people left actually. Now we are at the end of the terms, vesting terms or the vesting conditions of 2 years, vesting period of 2 years. Now 15 people left in year 1, another 20 people left in year 2, 25 people left in year 2 and altogether 35 people left sorry, 40 people left, then balance employees at the end of year 2 is 460. Then if you take the value 460, look the value here. Now this is important point. In equity settled share based transaction, we learn every time we need to take fair value on which date? In equity settled share based transaction, we took fair value on which date? Grant date. But look here, we go for fair value at the end of each year, because this is cash settled share based transaction, right? Here the value is 13 into 460 into 100, it's 598,000. It's for how many years again? 2 years. Vesting period also 2 years. The offer is valid only for 2 years. Therefore, this should be divided by 2 into 2 means, again, no need to divide it by 2 actually. Then total will be 598. Already we have recognized in year 1, how much? In year 1 we have recognized 232,500. Therefore, balance, how much? 365,500 should be recognized as expense to year 2. Then double entry, expense account debit 365,500, liability account credit 365,500. Now in your liability account at the end of the year 2, you can see it has been accumulated 598,000. Now at the end of the year 2, what you need to do? As you promised, what you have to do? You have to pay it by cash. Then your expected or the promise is how much? To pay 598,000 at the end of year 2. As promised, what you have to do? You have to pay it by cash to whom? To employees. Understand? So then my liability account will be closed at the end of the year 2. Got it? Right. Now, good thing in my exercises, we need to take all these workings. If you don't come for the class, you have to read or watch the full video. People who come for the class, they have workings written down. Therefore, if you just see the PowerPoint slides, no need to watch the video. PowerPoint slides plus this note is more than enough to learn, no need to watch the video. If you don't come for the class, you have to watch the video the full time. You don't want to watch the video, to learn it again. No need. If you come for the class, no need to watch the video. But you need to take down all necessary workings. If you take the workings, you take the PowerPoint and see, with that, read PowerPoints and see whatever things you have written, it is more than enough. You can save time. It's kind of advantage that I give for people who come for class. Because they give me kind of advantage. Why? Otherwise I feel lazy to teach. Right? If nobody is in the class. So they have to recognize that. In return, what I do, you don't want to read or watch my videos, just take the tute and take your workings. That is more than enough. Right. Because these workings are not in the note. To take these workings, you have to run through the video. It takes time. Since you have taken down everything, don't give it to others then. Right? To have kind of comparative advantage. Anyway, it doesn't matter. I'll take one more question. This is similar to the previous one. Now look this. Last question. This is also another exam question. We'll do this thing and stop. What it says. The reviewing the adjustments relating to IFRS 2. And directors are having kind of arguments on this. What is first question? You just see. Question is little big. It takes time. Where's question? This is the question, right? Draft a report to the board of directors of this company. The reasons why share-based payment should be recognized in financial statements and why directors' arguments are unacceptable. There are a set of arguments given by directors. Already I have explained everything. What is this? This is the first part we discussed. Merits and demerits of this. Right? So then what are the arguments given by directors? Let's see. These are the arguments. You have to write a report. They feel that share options have cost to their company and therefore there should be no expense, no cost, sorry, no cost to their company and therefore there should be no expense regarding its profit or loss. It is so. Now you have to write something against this. You have to say why you don't accept this argument. What you have to say? To break down all these, what you have to do? You have to say merits of this. Even though cost is there, not there, to comply with matching this thing, you have to recognize it. The second point, they do not feel that expense arising from share option and IFRS 2 actually meets the definition. Now look, expense under the framework document. Even though it is not coming under the definition of expense, it is part of remuneration. Given it's kind of promise given by employer to employee means promise also part of remuneration. Even though it doesn't have monetary value. To measure the real managerial capacity, we need to take expense into books of accounts. Otherwise my profit is misleaded. Profit is overstated if you don't recognize real expense. Therefore we need to recognize. Look the argument we had. Directors are worried about the dual impact of IFRS on EPS. You learn. Therefore EPS will be diluted. Yes, it's true. It happens only in the case of equity settled share based transaction. But in the case of cash settled share based transaction, it won't happen. But one side it's happening, not dual impact. Only one impact is there because we charge something to profit and loss account in a cash settled one also. But against this, what do you have to say? EPS is only market measurement. And EPS is kind of market measurement. That's only for investors. But they have other measurement called performance or the profit of the company. If profit is misleaded, no point of calculating the correct amount of EPS. Actually, one side EPS should be affected. Why? Only thing we have kind of hidden cost to profit and loss account. We take it now. So therefore EPS should come down. But the thing is EPS hit twice. Because of this shadow. Now one side, yes, it's true. If you issue new shares, ownership will be diluted. Therefore, EPS, the qualitative EPS should be decreased. If you issue shares to employees, what happens to my ownership? It will be diluted. It will be distributed among more people thereafter. It's kind of cost to the company. People will lose their control. Now, it's correct because we recognize that also in the books of account. That is fair. That is argument. Accounting for share base may have adverse effect on the companies, may discourage the, yes, right? Adverse effects. Accounting for share base payment may have an adverse effect on their company and may discourage it from introducing new share option plans. No, it's not so. There are some indirect benefits for the company. If we introduce this kind of share options, people will motivate to work. People will motivate to work. Therefore, directly there may be performance increase as a result of motivated set of employees. They have kind of clear target to achieve after a certain number of years within the vesting period. Therefore, people will work hard and contribute more for the company. That's why at the beginning I told you it's kind of win-win situation. Employer will win, also employee will win as a result of this package. That's enough for this. And thereafter, for the second part of the question, there are two directors, two options are given. No need to look about these names, these are foreign names. On this date, 20,000 options are granted, and here 50,000 options are granted. Two packages now for two people. Fair value of the option at the grant date is 5 here, and that date it is 6. Exercise price, that means at the end of vesting period, this person should pay 4.50 to buy. this person should pay 6 rupees to buy. There are certain performance conditions, we call it vesting conditions. Vesting condition A for this package, vesting condition B for this package. What is vesting condition A? What it says? The share option do not vest if the growth of the company's EPS for the year is less than 4%. Look the target. You have to wait, or we have to stay for a number of years. At the same time, you have to increase EPS not less than 4%. The rate of growth of EPS was 4.5 at the end of the first year, 4.1 at the end of the second year, and it came down further, 4.2 at the end of the third year. Look what has happened. What is their target? Target is 4%, but gradually it is deteriorating, decreasing. Still, now what is your condition? That's about directors must still work for the company on the vesting date. Yes, that means directors have to wait there at the time of period, 3 years, right? Then here two conditions are there. First condition, directors, that particular director, the person A, let's say, that person should stay with the company for 3 years. At the same time, he has to increase EPS by this much. Not easy, why? As a result of this thing, EPS comes down twice. You see the impact for the denominator and the numerator, right? It is applicable for first point, first side. We will complete that one. Right. Now at the end of the year one, we didn't see the date. Vesting date here, this will be started in 2005. The exercise date is at the end of 20x6. Here it will be started in x7 and ended by x8. Now what is the value of this? We will complete it first. Now at the end of, now exercise price is 4.50. What is price? Earning per share is how much now? 4.2. What is first point? First condition. Now how to account, now second part of this, how to recognize these transactions into books of accounts. Now at the end of, our date is wrong, it's 5/6. Anyway, at the end of, let's say, first year and second year, right? How many shares? You have to go back every time to the question. It's somewhere here. Look, share price per share is 12 rupees, and at the end of x4 means the date is wrong, at the end of the second year, let's say, to 12.50, that's share price, right? And also don't focus about this tax point, I don't consider it. Somewhere here. That's a condition. Yeah. Fair value on the ground date is how much? 5 rupees. How many shares? Now we can take the value from this. 20 into 5 rupees per share on the ground date. And look, 20 into 5 into, divide by 2 into 1, why? This first year in, right? Then its total is 50,000. Profit and loss account debit 50,000. We have to credit. It's equity settled. Reserve, other reserve account credit 50,000. At the end of the year 2, we will take balance 50,000 from the package 1. Now the other director will be given the chance from the second year. You can remember, 1 year after. Second year to third year, right? So then for his share is how many shares it was? 50,000 shares at 6 rupees. Then 50,000 into 6 rupees, it's How much? 300,000 divided by its condition is 3 years. His condition is 3 years. Vesting period is 3 years. Then vesting period of 3 years, then it will be 100,000. Profit and loss account debit 100,000. Reserves account credit 100,000. Then total reserves in my account will be how much? 150,000 at the end of year 2. That's all they ask. You have to decide now whether performance condition A is satisfied. Yes or no? Fulfill. Why? EPS should be only 4%. Even though it is deteriorating over the 3 years, it is 4.2, 4.1 something. It means it is more than 4%. Therefore, it is satisfied. Then you have to fill it. What is performance condition B given in this? Look this one. Condition B. The share options do not vest until the share price has been increased from its value of 12.5 at the grant date to above 13.50. But what is the ending value? 12.50. Then do you give them anything? No. Therefore, performance condition B is not satisfied. Therefore, company will not pay any amount to the person, the second person. Look the answer. Look. Not fulfilled. Why? It requires that expense for the service should be recognized even if market condition is not satisfied. Right? So therefore, market condition is not satisfied. That the market value per share is expected to have 13.50, but it was 12.50 at the end of first year of second person's vesting period. So therefore, second condition is, now what we have to do for that balance at the end of second year? Expense debit, other reserve credit, it was there. But at the end of the second year, we realized that, no, we don't want to give it by cash, or we don't want to give it shares. Now what we need to do? Anyway, we have other reserves balance at the end of the year 1. We have already accounted. At the end of the year, that person has not achieved the target. It happens, no? At the beginning of the first year, you think that he will achieve the target. Based on that, you transfer something to other reserve. At the end of the year 2, you realize that no, he has not achieved the target. Other reserve balance should be transferred to retained earnings. Remember, if you realize that at the end of the vesting condition, if you realize that at the end of vesting period, you realize that if you realize that the vesting condition is not satisfied, at the end of the vesting period, you realize that vesting condition is not satisfied, then other reserves should be, or other liability should be charged to, retained earnings. Retained earnings. Understand? Right, that's all about this. There are some other questions, you just read it later. Anything else? Enough. Oh, enough for the day. Tired, is it? Right, anyway, we don't have time to start the other one. It's kind of big one. Anyway, again, we have to spend 3 hours on that. The employee benefit, it takes time. Usually, we have 4 sections to be discussed. Short-term employee benefits, post-employment benefits, other long-term benefits, termination benefits. There are 4 categories. Here we had only 2, right? Out of the anyway, the post-employment benefits, another 2 subcategories. So therefore, we'll do it next week, right? You just, it is not there. It is there, no? This is not there in the system, is it? Which one is not there? In the LMS? This is there. No, this is not there. It is 19 is there, 2 is not there, no? Okay, I'll upload to this one today to the LMS. Huh? Human resource also. You read that one. Anyway, I gave the article, no? You read the article, right? Anyway, I'll upload human resource one and this thing, right? Okay, then we'll stop from this point and enjoy the weekend now. It's long weekend, no? No enjoyment. You have classes. Anyway, now. Okay, then we'll meet again. Next week we don't have classes. Following week.